Good afternoon, everyone, and welcome to our weekly webinar where we will talk about what we see happening in the global economy, what's happening in financial markets, in the world of wealth management, and how all of this impacts our decisions on the best courses of action for your investment strategy and financial goals. I want to thank you for taking the time out of your busy schedules to join us. We are recording this so that those who can't join us live can tune in when it is more convenient. I'm Scott Tomlinson, and I'm joined by my partner and colleague, Paul Tepsich, the founder of HighRock, and our financial planner, Bianca Tomlinson. We'll have a question and answer period at the end of the call, so if anyone has a question about any aspect of wealth management, we invite you to feel free to ask questions. And remember, if you have a question, it is likely that other listeners may have the same question, so please feel free to engage us. For those listening for the first time, HighRock was founded by Paul in 2010 to manage about $200 million in closed-end funds for Scotiabank, and we are registered with the Ontario Securities Commission. I joined Paul in April to help build our private client business, and we are 100% employee-owned. We're excited to have our unique business model already making an impact. All of our new clients are coming to us because they really like our no-nonsense approach. If you like what we're doing, our approach, our service, and our expertise, please feel free to recommend us to your friends, family, and colleagues. We do have room for new clients who might be a good fit to our style of low-cost investment and wealth management. Our private client division was established to take advantage of some of the synergies that come with the funds that we manage for Scotiabank. We are not brokers, we are not investment advisors or financial advisors. We are a portfolio management company who has a very clear understanding of wealth management. Now, importantly, all of us at HighRock have our money invested in the same models as all of our clients. So whatever we do for all of us. Our interests are completely aligned with yours. Our fees are simple and transparent, and we fully disclose any hidden or embedded fees, unlike most advisors. Importantly, we have come through a cycle of above-average portfolio returns over the last 5 to 6 years, and as we enter into a period of below-average returns, which will bring us back to the average, it is really important to pay attention to costs. One of the reasons we are attracting new clients is our desire to keep your costs low. As well, we take our responsibility to you with beyond what is required by the regulators with an independent review committee that reports directly to our clients to ensure that we are fulfilling all of our obligations to you. The first report was sent with our quarterly update and portfolio progress reports and will be sent each quarter in a similar manner. Well, fees truly do matter. If you look at the impact of fees over time, it can be astounding. And more importantly, you want to make sure what you're paying for. Well, it's easy for an investment advisor or portfolio manager to get you fully invested after you sign up. However, after 6 years of above-average performance for client portfolios, managing risk is now more important than ever as we enter into the lower return environment. Risk management becomes very important because we must be vigilant not to put our clients' money at greater risk in order to chase higher returns. The discipline is in picking the appropriate price points for buying new assets. This is some of the value that HighRock adds to our client portfolios. Our ongoing efforts for the management of your portfolio strategy is to find the best possible returns while simultaneously providing the least amount of risk in doing so. Naturally, this is done in the context of each of our clients' specific goals and their tolerance for risk. Our research shows us that a globally diversified and balanced 60% equity, 40% fixed income model can significantly reduce risk and still achieve an annualized return of between 7 and 8% over a multiple year period. This is what we consider to be the optimal portfolio. Now, rebalancing on a regular basis is crucial. Different asset classes will outperform or underperform at different times in a market cycle. Selling outperforming assets and buying underperforming assets will continually add value and return. Underperforming assets will eventually return to better performance, while outperforming assets will ultimately underperform. This is how profitability is realized and the new cash gets reinvested. Our discipline is our strict adherence to goals, to our goals-oriented investing, or your goals-oriented investing, to structured models, to protecting client capital, regular rebalancing, and in-depth research, a fiduciary responsibility, and of course, high levels of client service. At High Rock, we have three models which we use to create a balance and diversification. We have a fixed income model with government and investment grade corporate bonds. A small percent may be high yield corporate bonds, and we may also include a selection of preferred shares here as well. We have a global equity portfolio that focuses on diversification across thousands of companies in multiple economic sectors and across many geographic locations. As well, we have a model that focuses on Canadian small to mid-sized companies with which we have a great deal of familiarity and deep levels of research. This is an active or tactical model intended to obtain better than average growth. For our clients, we use these models to create portfolio strategies that are in keeping with your desired goals. Okay, on to our financial market themes for 2015. Well, we've been saying it regularly, but our central theme this year has been to expect surprises, and there's been no shortage of those. Last week we added a new theme that for the foreseeable future, with low economic growth, low earnings, low commodity prices, low inflation, and low interest rates, we're going to be in a low return environment, and investors need to adjust their expectations to that. Well, oil prices started the year making new multi-year lows, and their repercussions continue. After a period of stability from April through June, oil prices broke down and are now making new lows as supply continues to outweigh demand. But it's not just been oil prices. Copper and other metals prices have also been hitting multi-year lows, driving the commodity price index lower. Well, this leads us into the conversation surrounding inflation, or for that matter, deflation. There was a deflationary scare back in April and global bond markets hit their lows, but now with commodity prices making new lows, the deflationary concerns are back to front and center. Well, we know that bond markets lead other financial markets. So what are bond markets telling us now? In the U.S., some are expecting a Fed funds rate increase in September by 0.25%. This is partially built into short-term yields there. Farther out the yield curve, bond investors are debating future inflation. The real return, which is the current yield of approximately 1.2% in the 10-year area, less current inflation levels of approximately 1.2% as well, means that you're basically getting a zero return after factoring in the current level of inflation. In other words, bond investors at the moment are prepared to have the safety of U.S. government bonds, but the cost of that safety is a zero return. However, the desire for the safety actually signals greater concern over the potential of future low inflation or even future deflation. Perhaps not as much concern as there was in April, but still a great deal of concern. Interestingly, investors in corporate investment-grade bonds are demanding a higher premium over government bonds. Now, this indicates that they are concerned about the amount of supply that has been issued at relatively low yields, much of which has been used to raise money for share buybacks. Now, those share buybacks have been fueling the upward price trends in equity markets in recent years, despite lower earnings. As well, investors are concerned about the credit quality attached to these bonds, and they want the protection that these wider spreads are offering. Further, high yield or lower grade bond spreads have also been widening, further indicating that equity markets and bond markets are diverging. Now, historically, high yield has led the S&P 500. So we don't see any reason to think that it's going to be different this time around. And certainly from this chart, you can see that high yield, once again, is leading the S&P 500 lower. Well, once again, I say, if we know that bond markets lead other financial markets, what does that tell us about equity markets? Well, our view is that they're expensive. Not only are we seeing the divergence between corporate bonds and stock markets, but revenues and earnings are not growing and are not expected to grow, certainly in the third quarter of this year. For earnings, analysts are currently predicting a decline of 3.6% in the third quarter of 2015, and then expecting growth of about 2.4% in the fourth quarter. As far as revenues are concerned, analysts are calling for declines of 3% in the third quarter and just a little under 1% in the fourth quarter, and don't expect to see revenue growth in the S&P 500 until 2016. For all of 2015, analysts are calling for earnings to grow by just a little over 1%, but revenues to decline by close to 1.7%. Price-earnings ratio of 16.5 for the index as a whole is above the prior 5-year average and of 14, and above the prior 10-year average of about 14.1. So again, on a price-to-earnings basis, the S&P 500 continues to look expensive. In fact, share prices continue to be expensive relative to company valuations. We've seen share buybacks that have reduced the supply of equities out there, and also investors that are looking for better returns have increased their exposure to risk and have added equity risk. Buying expensive equities, making them basically more expensive. Greater demand and reduced supply have also added to these upward pressures. Now, interestingly, global mergers and acquisitions, we talked about this last week, well, that activity is on course to set a new record, beating the old record in 2007. Well, we all know what happened after 2007, as 2008 turned out to be a particularly difficult year for equity markets. So we see many reasons to be cautious from the fundamentals, and of course the technical picture, if it turns negative and we see more selling emerge, there's certainly lots of room for significant market correction. Certainly a correction to the degree of 20% could take us back to close to the highs of 2007. And that we would consider to bring value back into a more or less neutral position. Now, as portfolio managers, we have a very long-term perspective, but we want to remember back to the lows of 2009 and all the emotional concerns that went along with them. I remember having numerous conversations with clients explaining that we were at cyclical lows. Well, here we are, and we believe that we're at cyclical highs for equity markets. And this is certainly where balance and diversification and even patience will certainly come in handy as far as portfolio management is concerned. Okay, well, what's new in economic data? Well, in the U.S., the third quarter data continues to come out. Industrial production in July was a little bit better, but a leading index of future manufacturing in New York fell unexpectedly yesterday. Producer prices have fallen, and what of the U.S. consumer? Following our theme that baby boomers, who were the former big spenders, and millennials, the largest cohort, they're facing things like higher rental costs. So consumer or disposable income is reduced, but the consumer was spending as retail sales rose in July. They're spending money on cars and restaurant bills. As for other parts of the global economy, second quarter GDP in Europe declined, but at this point that's pretty old news. Core inflation jumped there in July, as it also did in the UK. So what of our fearless central bankers and their monetary policies? Well, Mario Draghi is still easing European central bank policy. Bank of Canada Governor Stephen Pawlas may have to cut again. But the U.S. Fed wants to raise rates, and it sounds like so does the Bank of England Governor Carney. So how are we positioning our portfolio models based on our assessment of the current environment? Well, as for our fixed income model, we have two concerns. One is interest rate risk, so what direction are interest rates heading, and how will they affect fixed income assets? And also another of our concerns is the duration risk. So where do we need to, or which part of the yield curve do we want to be involved in? And as a reminder, the yield curve is the rate of interest across the maturity spectrum from floating rates in the short term to 30-year rates and beyond in the long term. Well, when we look at the yield curve in Canada, we talk about what we're doing in our fixed income portfolios. So we did buy 10-year Government of Canada bonds back in May at much lower prices and considerably higher yields. But with current circumstances, the possibility of another Bank of Canada rate cut built into the short-term yields, and then in the 10-year sector with yields back at their lows, we're not seeing any real advantage, certainly after inflation is taken into consideration to buy bonds because the real return is now actually negative. So we're not anxious to add to our positions at this juncture. Higher yield bonds have moved lower in price, offering some very good yields on a risk-adjusted basis. Certainly this is an area that makes buying sense to us, so we look to add to our high-yield portfolios in the not-too-distant future, certainly wherever we see a need to do so. So as we discussed last week, preferred shares are another of our fixed income asset classes, and they have suffered on the back of lower interest rates, and the fact that many of the higher yielding issues have been matured and replaced by lower yielding issues. Rate reset preferred shares are now replacing the once popular and higher yielding perpetual preferred shares. The lower return environment has definitely impacted this asset class, but there are still some higher yielding perpetual preferred shares available, and prices and yields are looking attractive. So this will be our focus as we move forward for our clients. In our global equity model, volatility has eased considerably since the Greek issues, but the fundamentals and now the technical aspects of equity markets leave us with continued concern about putting additional cash to work in this current environment. This is just part of our disciplined approach working to our clients' advantages. Well, it's August and vacation season, so many markets are experiencing lighter than average volumes. Volatility is remaining at or near its longer-term averages. The S&P 500 continues to trade in a narrow range, and as we've suggested throughout today's webinar, we're not comfortable with the market until we see some lower prices. In Canada, commodity prices continue to impact the TSX negatively. Japanese stocks could not follow through with a test of their highs last week, but they still remain in their uptrend. Prospects of higher rates keep UK stocks trending down. Euro stocks, while off of their lows after the Greek situation, but they are still trending lower. Australian stocks broke down last week as commodity prices continue to drive the trend there. As for China and other emerging markets, the trend does also remain down, although Chinese stocks had been recovering a little bit. They fell over 6% earlier today, but still remain off their recent lows. Emerging markets, we're seeing that index look to start testing, possibly testing its 2011 lows, and again, monitoring this closely and looking for opportunities as they may present themselves. But nothing really has changed in our near-term outlook. We wait for continued corrective activity in the global equity markets and remain cautious about doing any buying at this juncture. Just, as I said, waiting for opportunities when these downtrends do resolve themselves. Now, I know Paul had take an important call. So I'm not sure if he's back with us at the moment. I do hear him there, though, so maybe he's got a bit to add here.
Thanks, Scott. We haven't really put on any new positions in the Canadian growth equity portion of our models, but I think I'm just going to add, I spend a lot of my days analyzing companies in the high yield space, and some of those companies are companies we look at in the Canadian growth equity model. So we've just gone through second quarter earnings season. There's probably still a few more to go. And I'll just give a quick recap on what I've seen so far. And the first one is a 30,000-foot view. We've been going through sort of commodity deflation, i.e. Energy prices were hit down obviously last year in the fall and through the winter, and rebounded a little bit, and then started getting hit down a bit again. But then it sort of contaminated to other commodities, basic materials, from copper to nickel to zinc, even lumber, quite frankly, even though we put in very good housing starts in the U.S. this morning. Everything got hit down really hard. So I would say within that commodity space, it's been a tough 2 months. But why I mention that is, well, two reasons. Number one, I think outside of that commodity space, some of the earnings seem to be pretty decent within the Canadian economy. And Scott said this earlier in the deck, and we say it every week in our deck, in our presentations, in our materials, is that bonds lead other capital markets. So I missed part of the call. I don't know if Scott went through it all, but bonds lead, whether it's government bonds telling us something, flight to safety, flight to quality, or it's credit, being corporate bonds like high yield telling us something. So if high yield has had a really rough 2 months, that our view is that it is likely to transfer into the equity markets. They typically lag by at least a few months, and I will just sign off by saying back in 2008, 2009, the high yield market bottomed in price in November of 2008, and yet the stock market did not bottom. The S&P bottomed in March of 2009, so there was a 4 or 5 month lag in there before the stock market bottomed. That's it, Scott.
Thanks, Paul, and yeah, you echo what I did say, but thanks for reinforcing it, because I think it's a really important message that we want to be ahead of the curve when we're analyzing not only what's going on in the macro global economy, but also with individual companies. And I think the depth of the research that we do and that you do, I think that comes out in some of our decision making that we do on behalf of our clients. So thanks for adding that. All right, well, that's it for today's discussion, and this is the time where if anybody has a question, please feel free to come forward and ask. All right, sounds like nobody's jumping in here, so if you do have questions and wish to email us, we certainly be more than happy for you to send them. We certainly also would love to get feedback on these webinars, what you think is good, what you think is not good, and anything else that you might like to see us cover on these calls. We want to make sure that we're talking about things that are important to our listeners. All right, so that's it for another week. Thank you all for taking the time to tune in. Have a great week, a wonderful weekend, and we shall return with another webinar next Tuesday. This is Scott Tomlinson signing off.